The Centaur Flexible Fund was founded in 2004 and aims to weigh up the risk and rewards inherent in the current share price of a listed company before making an investment. Centaur has assets under management to the value of 259 million rand. The managing director, Roger Williams, joins us on the desk for more. Roger, always a pleasure chatting to you. Yeah. And I think we need to kick off with your current views. We have got obviously a heated situation in South Africa unfolding at the moment. I refer obviously to the platinum sector. The big debate is whether we're going to see contagion across the mining environment.
Yeah, I think it's difficult really to answer that. It may spread. I think we're in for maybe a couple months of labour unrest. Whether there'll be contagion,
you don't believe in the resource story at this point in time anyway, do you? And this probably just feeds into, except for Sasol obviously, which is a big pick in your stable.
Yes. The reason why I think fundamentally resource companies are not great companies, the reason why they don't control the end product price, they don't control demand, and they actually don't control their costs. And then over and above that, they've also got their declining assets. You know, they normally run out after 30 years or 40 years. And superimposed on that, we've also got governments trying to take a greater share, either via taxes, empowerment. You look at the royalties tax in South Africa, Zimbabwe, they just basically expropriated 50% of the companies. So all these issues create businesses which really aren't great quality, and that's the reason I don't like them.
Okay, just on that, Roger, the argument with mining companies is that we're living in a world now that the population growth is increasing exponentially. Well, not exponentially in terms of percentage growth, but in terms of the amount of people as a nominal value that we have to feed, clothe, and house, and these sorts of things. And despite all these things that are affecting the mining companies, there's a strong argument to be made that the industrialization of China and India are very big themes and have, in the last 10 years, been terrifically rewarding for resource companies. What's your state on, if you're not buying resource companies, does that mean you're not buying into the China and India industrialization, or where does that leave your view of the world?
I think China went from a very low base to a massive, the biggest user of most commodities worldwide. And their resource intensity is very high, particularly in things like iron ore. They're the biggest user. I think they're 85% of the seaborne trade. And really, if you look compared to Europe and the States, which are bigger economies, their resource intensity is much greater than those countries. So you also have to be cautious, expecting them to continually take more and more resources. It may just start plateauing, or the growth rate may slow down. And also, there's more supply coming on stream. So you have to look across different products. Say iron ore, there's a lot of supply coming on stream from Australia, South Africa, Brazil. Copper, the supply response is much more muted, so that may be much firmer. But even if the prices hold at these levels, you've still got rising costs which are undermining their margins, and then they still have to replace the resources. So these are all major headwinds for these companies to really grow earnings, and that's the most important thing, to grow earnings, and there are a lot more attractive investment opportunities worldwide, in my opinion.
I'm going to go into the stocks that you have in your flexible fund, and we've often discussed RMIH on the show. It still is your biggest holding at around 10.7% of the fund, according to the latest fact sheet, or has that changed?
No, it's still, I haven't sold any. I hit the limit of 10%, and it's actually outperformed the fund. That's why it's over, despite the fund growing. I'm a big fan of this one. I think OUTsurance is an exceptional business. That's over 40% of the value of the business. And really, management of the whole group is exceptional. And the free cash flow and also their long range outlook towards profits is good. South Africa is starting to mature, but they've gone into the commercial space. That's OUTsurance, and then also they've moved into Australia, which is starting to show good promise. And then they also moved into direct life, and I think they can actually extend their brand into other segments. So I still like RMI, even though I wouldn't say it's cheap anymore.
It's not cheap. So
No.
you're holding on to the story, though.
Yeah, I think the growth will unwind over time, and then I also like MMI, which I think is the merger benefits are starting to come through, and Discovery also. I think that's a long-term growth story. So I'm willing to hold it.
Just on the MMI story, obviously the rationale when you acquire businesses and you combine businesses that are very similar is that you extract efficiencies. Do you think that the management team so far have been able to deliver what they've promised pre the merger?
Listen, I think these things are always more difficult, and there's people issues and people are unhappy. But
It takes time to bed down a story like this.
Yeah, I'm starting to see it now. They're starting to get on top of it. So maybe it was a bit delayed. They couldn't lay off people. But now you're starting to see them to vertically integrate across the value chain. So they're taking out certain elements. For example, in the unit trust business, they've merged their business. They're using in-house software, so they're saving money there. They're taking out outside service providers. So you get massive benefits over the medium term, and then you're a much stronger force really to go forward from there.
Right.
So I think it will come through.
Do you want to stay with RMIH, or can I move on?
You can move on now.
Richemont is another stock that we've discussed extensively, and really what I'm trying to get is a feel for when you're going to let these stocks go, or do you continue to hold for further upside?
Yeah, I think Richemont's just a great business. Very high margins, good return,
Defensive.
good cash flow. I don't know if it's defensive, it's quite cyclical, but I think it's a secular growth story over the long term. People want luxury goods. As they get disposable income, they don't necessarily want more products, they actually want just better quality products, things they treasure.
When I say defensive, often people make the argument that because it is so high end, that LSM consumer doesn't get affected by an economic downturn, or does that not hold true?
I think it is a bit cyclical to the global economy, but superimposing that, it's a long-term growth story. So it may come down within that cycle, but say in 5 years, the volume growth will be at least 5% per annum, I think.
Just, I know Bronwyn blitzed straight into the stocks, but one of the things I wanted to ask you is that within a flexible fund, one of the benefits is that you can choose to sit out of the market if you view the market as being overvalued, or you think that there's some big risks to market prices. Where do you stand at the moment in terms of your fund? What percentage is invested, and what's your take on the valuation of the market as a whole at this point?
I think in the short term, valuations don't really determine the market. It's really the interest rate environment and the mood. And I think, it's counterintuitive. People are always looking at valuations, but where we are is we've got very low interest rates worldwide, which is very positive.
We've got another MPC decision on Thursday, and although the market is saying that we're not going to see a cut, we were surprised last time, it could happen again.
Yeah, I'm not expecting anything, but I mean, interest rates are at record lows. We can't see them going up. Globally, you've got bond rates in Germany and the USA under 2%, which is very conducive. We've got positive momentum worldwide. And also the last quarter is a very strong quarter, always. And then we've got a presidential election. So I think it's a very positive environment in the short term, at least till year end. More medium term, I'm a bit worried about South Africa. I think there could be stagnation. Investment in really deep level mining is really going to come to a halt. And the platinum industry was a growth industry, and it's not anymore. And I think there's a lot of uncertainty. There's lack of leadership in South Africa. Unions, despite unemployment of 25%, you're getting very high wage demands, and it's not conducive to growth, and superimposed on that, we're also getting greater and greater regulation in South Africa. So I'd be a bit cautious on South Africa.
Does that mean
beyond year end?
Does that mean you're taking money off the table at this point?
So in terms of your allocation?
I'm actually switching. I've taken 15% offshore. I've invested that in Europe. I think Germany is a very good bet. You've got very good companies there, modest valuations, and a very strong economy, and also very good corporate governance. So I really like Germany as an investment destination. So 15% offshore. I'm going to look, if the rand strengthens further, I'm going to look to move that up to 25%. I'm taking a bit off the table on the retail, more domestic cyclicals, and then I'm holding quality companies that are actually winning in this environment. So, for example, FirstRand, I think, had very good results. I think their strategy is right for the moment. Their return on equity is over 20%, sort of forward P of 9.5. I still think that's reasonable value. I'd be willing to hold that. But maybe Standard Bank or ABSA aren't quite following the right strategy, and they may lag in the medium term. So that's really my strategy, but I'm very long at the moment. The fund's about 290 million. I can reduce exposure very quickly. I've got flexibility, and I'd look to reduce towards year end. I'm going to ride, the short term, positive
the momentum, the wave.
Yeah, I think, you have to sometimes hold on, even though I see storm clouds and risks. Try get out at very good prices if you can.
Okay, one of the points you mentioned there is the first round results, which were very positive. Some of the fund managers I've spoken to have been thoroughly impressed with the technological innovation that Michael Jordan has unleashed at First Rand. Is that a moat for the medium term for that business, or do you think, how long do you think it's going to take before the banks can catch up with that innovation culture that they seem to have developed there, which is not only lowering the cost for products, but it's just making the actual client experience so much more appealing?
Yeah, I think it's a while before others. One thing they have done, which I think is working wonders for them, is also their e-bucks scheme. So the very successful companies these days are actually giving something back. So OUTsurance is giving something back through their out bonus, First Rand through e-bucks. And those started over 10 years ago. So that is, that positive feeling when you get something back is quite hard to replicate and takes years. So for example, I see Absa has launched something for their credit cards, but it takes years to get momentum, and I think they've got a couple of years, they're a couple of years ahead of the competition in that respect.